In this session, I'm going to talk about some of the statistics underpinning the strength of the Australian property market. My name is Adam. I educate others to use a property developer's knowledge on how to make money from property. And that can be any sorts of types of property. So you might have heard of this website. It's called SQM Research. They put out a whole lot of data. It's completely free. And I want to showcase a little bit about the data that they produce, but also about how to interpret it in the current marketplace. So if you go to SMQ Research, you've got a whole lot of free data that's here. You can buy some stuff from them. So obviously they've got some paid reports as well. But look, a couple of things I just wanted to look at and highlight was some of the listings, and that's currently in the market, but also where we're sitting with vacancy rates. And you've probably all seen the headlines to say that vacancy rates are quite low, property market's falling, rents are increasing, all that stuff. It's all completely true. Vacancy rates are really low. Stock on market's still really low around the country. And it will really underpin the strength of the market moving on into 2023 and then beyond that. So we're in a little bit of a glitch at the moment, interest rates rising, the negative media sentiment in the market, around mostly the media scaring people, and also a lot of people sitting on their hands waiting to see what interest rates will do and when they're going to jump into the market when they think the bottom of the market will occur. You can see listings, and I've just jumped onto Brisbane. Listing levels have risen a little bit, but they're still low. You ever look back to 2010, and I remember the market in Brisbane in 2010, 2011. That was when I was just getting started in property, and I was in the market at that point, and there weren't that many listings back then. And when you consider that compared to now with population increase, fast forward, 12 years later, our listing levels are still really low. So this is Brisbane. Obviously, every capital city has their own listing levels, but if you just had a look at the list, Canberra, listing levels are still low. They're at 2011 type levels in terms of total listings. And you can see, if you have a look at, over 180 days, that has reduced. So, that's Canberra. It's not just the amount of listings, but also how long they're sitting on the market for. Keep in mind, this is a broad brush as well. Each suburb is going to be different. So I do say, drill down into each suburb, not just have a look at the entire market. So I am being generalistic here. So have a look at Sydney. Now, Sydney, as we know, you've seen all the headline data that listings have gone up, properties values across the board have reduced, but really it's not that bad. Look at total listings back in 2019, even leading up to COVID, with properties on the market for 180 days. So if you have a look at those or that data, compare it to now, the media is really painting this really negative picture, especially about Sydney and Melbourne, but it's not as bad as what people think. I mean, there's going to be suburbs that will have dropped 20% already, but those suburbs will be would have been overpriced, where people just went crazy. If you stick to safe suburbs, safe pockets that are in highly restricted areas, and this comes back to the fundamentals of property, and if you understand the property development process and cycle, you'll understand how the value of property moves. If you're on the outskirts of Sydney in a growth location where it's first home buyers, those markets are going to be affected. You've also got to think about the buyers. Can they afford to keep paying higher interest rates? Probably not, because most of them are probably putting down 5% deposits or less. And there's ultimately unlimited supply out there. Move closer into the city, into more affluent areas where it's highly restricted, you'll still have multiple people competing over properties, providing that it's highly restricted supply and there's not this brand new development with 1,000 units getting put up in that area. So that's Sydney. Jump on to Darwin, and Darwin is, still running okay. I wouldn't say that I'd love to invest in Darwin. It's a long way away from where I am, and it's a small market. So I'm not really overly fond of Darwin. I've never really entertained Darwin as a property market to invest in, but sure, I know that they've gone through, highs and lows, and they've come out of a pretty good high, as with most other capital cities. But my preference personally is to stick to the East Coast, Brisbane, Sydney, Melbourne, personally, just because those markets are a lot more stable than other markets. But, if you time the market right, with these more regional cities like Darwin, and WA is no different, then you can make a lot of money in those markets still. And if you already live in that area, property is a real thing. It's bricks and mortar. If you were buying interstate, I personally believe that you should actually go and inspect the property, and especially if it's your first buy, and then actually walk the area and understand the area really well before actually buying a property. And for most people, a property purchase is or will be the most significant investment in your life. So why would you buy something that you haven't even looked at, and to put ultimately your life savings into that? Once you start getting a bit more sophisticated and you're doing multiple property deals, I still look at all the property deals before I purchase them, but there's plenty of times where I'll do 99% of the research, before I've even looked at it, because I know what to look for. It's not my first rodeo, and I've had a lot of property experience and property transactions. So it's very different to if you've only bought 1, 2, 3, 4 properties. So I've transacted a lot more properties than that in a very short period of time. I have a look back to Brisbane, I mentioned before, and I live in Brisbane, so it's easy for me to look at this graph and know what the market's doing. Very low stock levels, and there's some areas that are being affected in Brisbane and surrounds. But again, when it comes back to restricted supply, the areas that I'm developing in that have restricted supply, they haven't really been affected in terms of price. If anything, they're probably still growing in value. It's just that there's no or hardly any stock on the market. So it's actually really difficult to tell which areas are actually growing significantly if there's limited stock and there's limited sale comparison. So a lot of people are just sitting on their hands, sellers included in Brisbane. And Brisbane didn't have the high highs and low lows like Melbourne and Sydney in the 2013 to 2016 boom. So Brisbane, in my experience, has been a lot more stable than those markets just across the board. I haven't really seen properties come back in Brisbane, only the unit market where it was oversupplied and people overpaid through project marketers. But generally speaking, Brisbane has run pretty well flat. If you overpay for a property, then that's on you. And if it comes back by 20% because you've bought a unit off the plan from project marketers, then that in itself, that could happen. It could come back by 20%. But if you're being astute with your buying, whether it's a new property or an existing or you're developing, then that's not going to matter. In my opinion, if you buy correctly, buy well, you'll at least have the property market stay flat for your type of property. So that's on total property listings for Brisbane. If you jump over to Adelaide, they're low as well. I won't go into any more detail about Adelaide. Hobart, it's exceptionally low, but I mean, Hobart is a small market as well, keep in mind. Now, Melbourne listings, you're probably not surprised by that it's not significantly low as compared to, the markets we just looked at, Brisbane, Adelaide, Hobart. So again, there's a lot of negative media sentiment around Melbourne and Sydney. Stock levels are up. There's areas that are in oversupply, sure, and there are areas in undersupply as well. Perth has very low listings, but overall, it's still relatively high. I'm actually really surprised by Perth market overall listings, because some suburbs that we have been looking at are actually quite low with their listings. So that does actually surprise me a little bit, that it is a little bit higher. And that's pretty much every capital city around Australia. Obviously, if you use this website, you can go into more centralized or go down into other more smaller areas. So check out this website for yourself and see whether that resonates with how many properties are on the market that you're looking at, if you're looking at purchasing, and what does that mean for your property value into the next couple of years. Are you still going to be in undersupply? Are the listings going to be low in your area, or is there a new development coming and there's going to be another 1,000 listings or 2,000 listings in the next couple of years? So keep that in mind. Once you understand that development cycle, then you can understand how projects and properties get released to the market. And it's developers that are providing new stock. So if you understand and know the same things that a developer knows, you're going to understand more about the market cycles, because a lot of supply and demand drives the market. Now, the other thing I wanted to look at was vacancy rates. I'll look at obviously the different cities again. Brisbane, love Brisbane in terms of the next little bit. And I just think it's such an affordable city compared with Sydney and Melbourne, and there's just so much potential. But if you're not from Brisbane, don't think you're just going to come to Brisbane, buy a property, and it's just going to double in value. You still need to be astute with your buying, but I think there's some great buying opportunities in and around Brisbane still. And, you see really low vacancy rates. Again, I remember the last time they were super low, which was around, post GFC. It was around 2010, 11, really low vacancy rates, but nothing compared to what we have now. And then in 2013 and beyond, the market grew, vacancy rates increased as new supply came to market. And that's where we saw values stagnate. The unit market values actually declined. But over time, that stock gets taken up. So what's going to happen now, and I'm not going to compare this at the moment, but if you have a look at new building in the area, so if you've got an area that's got no properties available and there's nothing getting built, then over the course of the next couple of years, that vacancy rate is only going to get worse in that area. And what will happen in due course is that vacancy rate will etch up as more properties get developed, get brought to the market. So we've got a massive undersupply nationwide, but Brisbane, you can see from this, is just absolutely terrible with supply, and that's why there's so much pressure on rents. So have a look at Canberra. Canberra's high compared to what it was before, but vacancy rate is still 0.9%, which is really, really low. Once you start getting below 2% in terms of vacancy rate, that's when you really start to have a really tight rental market. So if you're a renter, it's not good to be a renter in these sub 2% vacancy rates. But if you own a property and you want to rent it out, this is a great time to be renting out a property with low vacancy rates. Sydney, overall across the board, Sydney's got low vacancy rates as well. You can see it came off a high of like 4% back in 2020, even around 2019. But again, there's still an undersupply of properties in Sydney, especially in certain parts, concentrated more towards the inner ring from my experience with Sydney market. But you can see, historically, Sydney has been sitting fairly low. So it's no different to where we were kind of sitting, 2011, 2013, and even through the boom, 2013 to 2016, the most recent one, vacancy rates didn't really change that much across Sydney. And Sydney is a much bigger market as well. Darwin's vacancy rate, super low, but you can see, and I mentioned it before, Darwin is a smaller area, smaller place. So you can have high vacancy rates, and that's when the market in those sub-regional areas will really start to come off, is when your vacancy rate does start to etch above 2%. And this one, it's gotten as high as 4%, which is not going to be good. It's going to be a renter's market. So when you're in markets like this, you're better off to be a renter than a buyer, and you do rent vesting, where you rent a property and you go and buy an investment property in another area, not necessarily Darwin. And then Adelaide, super low vacancy. But again, Adelaide's pretty small. You can see how much it's come down from 2016 back down to 0.3%, which is absolutely crazy. Hobart, low again. And I know Hobart's had some pretty crazy growth over the last 10 years plus. So the vacancies have really gone from 3% in 2012, and then obviously there's no supply to the market. Now, I haven't personally invested in Hobart. I've never even really looked at property in there. It's just so far away and it's such a small place. But I do know other people that have purchased and invested in Hobart and have done really well out of it. That's just not a market that I want to play in. I only want to play in the bigger capital city markets where I know that there's always going to be ongoing demand. And that's just me personally. You can have your own rules about investing, but that's my personal rules about investing into areas. Melbourne's got a low vacancy rate, but I do know Melbourne has some pockets which are in oversupply with regards to vacancy. So when it comes to looking at these, it is a broad brush. It's not about every property. So, if you own a 2-bedroom apartment and it's in Docklands in Melbourne, or it's in the inner city, and at the moment you're competing with heaps of other 2-bedroom apartments, and maybe there's another one, I haven't been to Melbourne for a little while, but maybe there's another building getting finished and it's got another 1,000 2-bedroom apartments, well, then you're going to be in oversupply for that product. So your vacancy rate in terms of that type of product is going to be a lot higher than 1.5%, which is across the board. So you want to be in an area, not just a city, but an entire, a suburb where the vacancy rate is low and low for your type of product. So your 3-bedroom house, 4-bedroom house, whatever it is, you want it to be a low vacancy rate for your type of product, not just, hey, the whole area with all properties has a low vacancy rate, but let's just buy anything and then it sits there because nobody wants to rent it, or you've got to drop the rent. And then Perth, super low vacancy rate. So if you're in Perth at the moment, the market there is crazy with rentals, and you can see that from the low vacancy rates, 0.4%. But you got to remember about Perth, it really, and I know people have tried to say that it's not, a mining town, it doesn't rely on mining, but it's only 1 million plus people. It has a heavy reliance on mining, and it's very secluded from the rest of Australia. So it is very isolated. So you watch every time Perth's market, when the mining picks up, which it has done over the last few years, especially now with the war in Russia continuing, those commodity prices are probably going to come back a little bit, but we're going to see them high for a little bit longer. So there's a lot of money circulating in and around Perth. So don't be surprised if Perth has a massive boom off the back of low vacancy rates, and we see rents in Perth absolutely go ballistic because of the low vacancy rates, the availability of labor, and a lot of people have lots of money because of the commodity boom. So that's across all the major capital cities in Australia. Just keep in mind, you are buying only one property in one suburb, unless you're buying hundreds or thousands of properties. Just take these graphs with a grain of salt. Pick the market that you want to invest in. My opinion is to stay close to where you are, at least when you're getting started. And then, once you get a bit more experience, then you can start to look at different areas. But just because an area, and in a city like, say, Perth might experience a higher growth rate over the same period of time doesn't mean that you can't buy a property somewhere else, like in Brisbane, and that property isn't going to experience as better or as good, if not better, higher growth rate than something in Perth, even if those markets are performing differently. It's about buying well, buying under market value, and it's not hard to buy 10% under market value. So it doesn't really matter what market you're buying into. If you're buying into 10% under market value, another market has to have 10% growth just to make up that 10% you've bought under market value. So it's really very property specific in terms of the individual property that you're personally buying, not so much about the whole broad market. But if you are looking at investing, I would say go and have a look at this free data first. There's obviously paid data from SQM, and there's other sources that I use as well. We also subscribe to different people and different economists that give us data. So we obviously are in the business of developing property. We want to be in areas where we're developing property where that market is going to at least stay stable or incline. And those areas typically are more concentrated to the inner city, where there's not going to be an oversupply and there's a buyer that can continue to afford that property into the future. So they're just really basics, and I hope that's really helped if you are looking at buying your next property or property development deal, whatever that may be. If you've got any questions, please let us know in the comments. Otherwise, have a great day and subscribe to the channel for some more videos.